So let's jump into it, talk a little bit about the Sprott Uranium Trust. I do have to say that after last year's crazy roller coaster ride and all things uranium and other commodities, it's hard to believe that that volatility continues this year. I thought we were going to have a little bit more of a normalized year, but that was obviously wishful thinking. So let's get into this and talk a little bit about some current thoughts here. It's just a disclosure. I'm not going to go through a lot of this because I think Andrew, yourself, and Treva did a really good job providing the backdrop of, obviously what's going on in uranium. I'll talk a little bit more about the vehicle and what we're doing specifically and seeing in the spot market. And I do want to just talk a little bit about the impact of the Iranian war on nuclear, because I do think it is another example of a energy crisis which will galvanize energy policy and continue to push this whole nuclear renaissance further down the chain. So I think this is really important, and I'm just going to share a slide that I built in the last few days, and I thought this was just super fitting that the president of the European Union, as well as the German chancellor, both in the last 2 weeks publicly said that phasing out nuclear energy was a mistake. I guess it only took two energy crises and oil and gas shocks for them to finally acknowledge they made blunders. And I do think that this whole shift back to nuclear energy is going to accelerate because of what's unfortunately happening in the Middle East. And that's because uranium is the most densest form of fuel in the world. And it is not a just-in-time energy system like you have with oil and gas. And right now, all the nuclear power stations are working perfectly. There is no disruption in terms of logistics or shipping. And this is another reason why we continue to be very bullish on this longer term build out. And so we expect this to be a continued tailwind. Okay, let me pivot over to the spot market and the long-term contract base price. And what we basically are showing here is basically the charts going back from the beginning of 2012. This is basically shortly after the earthquake and tsunami in Japan. And you can see we went through a long bear market and a long consolidation period. And that obviously has changed over the last 5 years, where a new bull market has formed. And those two things tend to move together. Now, again, Treva publishes a term price once a month versus a spot price that we get once a day. And so you get, more recurring signals, price signals in the spot market. And you also can get the spot market, which is more driven by investor sentiment in the short term, and more headline news. And it can also move and be more forward thinking or forward reacting than the term price. And you can see that in the last couple of years, we've had a couple of interesting dislocations between the two. 2 years ago, we had a lot of excitement about nuclear energy and supply deficits, and the Kazakhs basically walking back a lot of the production targets. And the spot price really raced ahead of the term price and then corrected. We saw the complete reverse about a year ago at Liberation Day in early April of last year, where the spot price basically dislocated the other way, where we had a large price differential of about $17 a pound. And that obviously has corrected itself as the market has come back to reality and realized that there are no tariffs on uranium. And yes, trade policy remains still unsettled. The two prices have more or less converged. This chart's a few days old, but uranium in the spot market's about $85, and the term price is at $90. I will point out that the $90 base price is the highest uranium base price since 2008. So I think that's a pretty bullish signal that the price is moving in the right direction, even though we haven't had a lot of contracting, with the exceptions of the Chinese, the Indians, and the South Koreans, who've probably been the most prolific in terms of locking down future supply. Okay, let's shift to SPUT. So we specifically started this chart on when Trump won the presidency in 2024. And I think it's very interesting that we basically, given all of the uncertainty related to energy policy, trade, tariffs, Inflation Reduction Act, etc., the market really flatlined on us. We did not raise any money. That's that flat line, SPUT capital raised. We did not raise any money for 6 months. And we obviously were getting a lot of questions saying, you know, the backdrop for this investment is very bullish. Why isn't the vehicle trading better? Why aren't you raising more capital? And again, the vehicle is really a function of investor sentiment, and we respond as a byproduct to what investors want to do with their capital. And we were, you know, preaching patience and trying to educate the market that this was a short-term dislocation, really driven by a lot of trade uncertainty. Remember, Trump was going to solve the war in Ukraine in a week, and Russia was coming back into the global supply chain. Well, obviously, all of these things did not play out, and you can see from about middle of 2025, the vehicle basically started to raise capital again. And from the middle of last year to today, we've raised about $1.3 billion. This is the most money in dollar terms that we've ever raised. I think this is a very important proof point that investors are firmly engaged and behind this investment thesis. I'd also note that these are not investors like 2 years ago that were more tourists who were kind of chasing this AI bubble. And these are investors that have clearly done their homework and have recognized the dislocation last year and got behind the vehicle. So we appreciate that support. Now, what have we done with all the money? You can see that we bought no uranium from November 2024 up until June. And then we went on a very strong buying binge where we bought 8.6 million pounds of uranium in 2025. And we've purchased just over 5 million pounds so far this year. Now, why am I getting into these very granular numbers? It's because we have an annual limit on how much uranium we can buy. That is 9 million pounds. That was imposed by our regulator. And we just renewed our prospectus in January with the exact same limit for the next 25 months. So we're basically operating under this undertaking that's in the prospectus, it's very well detailed, that we will purchase no more than 9 million pounds in the spot market. Now, I'm going to define what the spot market means because it's very clearly articulated in the prospectus. The spot market is defined as delivery within 365 days. And why I'm getting into this minutia is because we've already bought 5 million pounds of uranium so far this year. We have cash to buy probably another 500,000 pounds. And we've gotten a lot of questions in the last couple of months around, well, what happens if you hit your 9 million? Is the trust going to be handicapped? Is it going to become dormant? Are you going to be able to raise more capital? And the answer is our contingency plan, once we approach that 9 million pound limit, is to extend our purchases out beyond 365 days as defined in the prospectus. We have never done this before. We've never gone past 6 months, and most of our purchases tend to be 30 to 60-day settlement periods. But we feel as though this is a viable backup plan if we burn through the 9 million pounds in either this calendar year or next. Now, what are the implications of doing that? Well, we definitely think there will be a slightly higher cost to acquire that uranium because you're basically asking somebody to carry it for you until they have to deliver it to you. So the fund will have to basically hold the cash against delivery and pay a slightly higher price for that material to compensate someone for carrying it on their balance sheet. So this is something we've started to message over the last few weeks, and this is our game plan for the current prospectus. And you can see that right now the trust is sitting at just a smidge under 80 million pounds. The price of uranium, you know, when we started to buy a lot in January and early February, briefly touched $100 a pound. We've obviously pulled back to the mid-80s. Some of that was a little bit of euphoria coming off, but obviously the troubles in the Middle East have taken the last number of dollars off the price as well. Okay, just to give everyone a little bit longer perspective, the vehicle was launched in July of 2021, so it's coming up, I can't believe it, to 5 years. And you can see that this is its net asset value, which we mark every night, against its market price. And you can see that generally these things are fairly held together closely, the relationship. You can see periods where they break apart, and those tend to be opportunistic buying opportunities because typically within a few weeks or months, those two price lines reconnect and represent good buying opportunities historically. In the last few days, the discount has widened a little bit. Obviously, we've been in a severe risk-off environment for the last week or so. Last week, we're trading around NAV. This week, we're around -5%. We would expect that it's going to be very headline-driven and sentiment-driven, given what's going on in the Middle East. People are just kind of taking bets off the table across the board. But the price to us seems somewhat depressed on the back of this. There's no destruction of uranium demand. There is no thrifting of uranium. There is no substitution of uranium, which we inevitably see in other materials. And it's one of the reasons why I think uranium is so interesting, because you cannot thrift it and you can't substitute it like you can others. So overall, this is a good barometer of where we are in terms of market sentiment and investor expectation. So just to kind of wrap up, I think what's really been driving everything is energy security. You obviously cannot run large-scale economies on the back of renewables alone. Yes, we see a lot more grid-scale batteries coming online, but nuclear is really the backbone of your grid. Baseload power, and it happens to be zero carbon. So that is really important. Security of supply risks remain very high across the whole fuel cycle. And yes, they are slowly being de-risked, but they remain. And last year was a really odd year in terms of utility contracting. We had overall not a huge number, and most of it came in the last 2 months of the year, excuse me, as a lot of the utilities were just sitting on the sidelines waiting for more clarity. And as Treva mentioned, there are a lot of projects in the pipeline, but we know that there are always risks, either delays, and these can obviously jolt the market. There is a massive supply gap that needs to be covered in terms of primary production going out to 2040. This basically creates inelastic demand. And in our experience, talking about uranium for the last 5 years, it has really, really become more, I think, understood. It's become also more accepted. We don't have these kind of legacy stigmas related to nuclear energy anymore. Most investors we talk to are well past that. So maybe with that, I'm going to pause my presentation to open up questions.